Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll delve into the top 9 REITs to buy in 2024. Real estate investment trusts, commonly known as REITs, offer investors an excellent avenue to capitalize on real estate opportunities without the hassle of owning physical properties. These investment vehicles pool funds to invest in various types of real estate assets, such as commercial properties, residential buildings, healthcare facilities, and infrastructure. REITs typically generate income through rental income, property appreciation, and capital gains from property sales. They are required by law to distribute a significant portion of their income to shareholders in the form of dividends, making them attractive for income-oriented investors. Additionally, REITs provide diversification benefits to investment portfolios and are traded on major stock exchanges like regular stocks, providing liquidity and ease of trading. So before we start, we kindly ask that you like this video and subscribe to our channel for weekly updates. Let's get started. Let's explore 9 of the best REITs to consider adding to your investment portfolio in 2024. Number 1 on our list is the Welltower Inc. Welltower Inc. stands out as a leading healthcare REIT, specializing in investments in various healthcare facilities, ranging from senior housing to specialty care facilities and medical office buildings. Over the past 12 months, Welltower has demonstrated exceptional performance, boasting a remarkable surge of more than 18%, making it the top performer among stocks in its category. Notably, in the third quarter alone, Welltower sealed deals amounting to a staggering $1.4 billion in acquisitions, underscoring its proactive approach to expanding its portfolio and market presence. Kevin Brown, an esteemed chartered financial analyst, attributes Welltower's success partly to the favorable impact of the Affordable Care Act. This legislation has served as a significant tailwind for Welltower and other prominent healthcare real estate owners. Brown points out that top-tier healthcare systems continue to direct patients toward these facilities, bolstering their occupancy rates and revenue streams. Moreover, industry experts at Morningstar have bestowed a buy rating upon Welltower, with a fair value estimate of $103 per share. This assessment reflects confidence in Welltower's future growth potential and its ability to generate value for investors. Despite closing at $87.93 on February 2, Welltower's trajectory and strategic positioning suggest promising opportunities for further appreciation in value. Number 2. Crown Castle Inc. operates as a specialized REIT with a primary focus on owning and managing wireless communications towers. However, the past year has been challenging for Crown Castle, with its shares experiencing a significant decline of more than 33%, marking it as the worst performer among the stocks in its category. Matthew Dolgan, a certified financial analyst, sheds light on the factors contributing to this downturn. These include activist pressure urging the company to divest its underperforming fiber business, a slowdown in spending by wireless carriers, concerns regarding liquidity, and speculation about a potential dividend reduction. Despite these challenges, Dolgan reassures investors that apprehensions about the company's future may be exaggerated, and he asserts that the dividend remains secure. Morningstar, a reputable source for financial analysis, maintains a positive outlook on Crown Castle, issuing a buy rating and assigning a fair value estimate of $130 per share. This suggests that despite its recent struggles, Crown Castle possesses intrinsic value that exceeds its current market valuation. With shares closing at $108.32 on February 2, there may be an opportunity for investors to capitalize on the perceived undervaluation of Crown Castle stock. Number 3. Realty Income Corporation specializes in the ownership, development, and administration of retail real estate properties, especially single-tenant buildings, and is one of the top retail REITs in the U.S. Notably, Realty Income holds the distinction of being the largest triple-net REIT in the nation, which means that tenants are responsible for covering all property expenses, including real estate taxes, maintenance costs, and building insurance. One of Realty Income's standout features is its impressive dividend yield, currently standing at 5.7%. What sets Realty Income apart is its practice of distributing dividends on a monthly basis, making it an enticing income source for investors seeking regular cash flow. Analysts, including Brown, highlight Realty Income's portfolio of retail clients, emphasizing their high-quality nature. These companies are often service-oriented and possess attributes that insulate them from the challenges posed by e-commerce competition or economic downturns. This characteristic adds a layer of stability to Realty Income's revenue streams. Morningstar's endorsement further underscores the attractiveness of Realty Income as an investment opportunity. With a buy rating and a fair value estimate of $76 per share, Morningstar suggests that Realty Income stock may be undervalued relative to its intrinsic worth. Despite closing at $54.19 on February 2, this assessment implies potential upside for investors considering a position in Realty Income. Number 4. Avalon Bay Communities Incorporation. Functions as a well-known multifamily residential REIT with a focus on the creation and administration of posh apartment buildings. Despite facing challenges related to supply growth in the market, Avalon Bay remains positioned as a key player in the industry. According to analyst Brown, while supply growth may exert pressure on Avalon Bay's rental rates and NOI in 2024, factors such as robust job growth and income growth in the company's established markets are expected to bolster demand. Brown maintains a positive long-term prognosis for Avalon Bay, highlighting the company's resiliency and capacity to weather temporary setbacks. He projects that the company will continue to achieve same-store NOI growth rates approximately 1% above the inflation rate, even amidst a challenging economic environment. Morningstar, a trusted source for investment analysis, shares Brown's optimism regarding Avalon Bay's prospects. With a buy rating and a fair value estimate of $233 per share, Morningstar suggests that Avalon Bay stock may be undervalued relative to its intrinsic worth. Despite closing at $175.06 on February 2, this assessment indicates potential upside for investors considering a stake in Avalon Bay Communities. Number 5. SBA Communications Corporation. Operates as a specialized REIT, boasting ownership and operation of a global network of wireless communications towers. Analyst Dolgan highlights SBA's strong positioning within the U.S. market, along with promising growth opportunities in international markets, both in 2024 and beyond. Dolgan suggests that SBA should pivot away from its risky strategy of leveraging up to fund stock buybacks, and instead focus on expanding its presence in developing markets. By reallocating resources towards strategic international expansion, SBA could capitalize on untapped growth potential and solidify its position as a global leader in the telecommunications infrastructure sector. Despite potential challenges, Dolgan remains optimistic about SBA's growth trajectory, anticipating continued expansion at an impressive pace. Morningstar reinforces this sentiment with a buy rating and a fair value estimate of $260 per share for SBA Communications stock. While closing at $224.71 on February 2, this assessment suggests that SBA Communications stock may be undervalued relative to its true worth, indicating potential upside for investors considering investment in the company. Number 6. Equity Residential Properties Trust. Equity Residential operates as a multifamily residential REIT, renowned for its diverse portfolio of apartment properties. Analyst Brown anticipates a moderation in Equity's growth rate in the upcoming quarters, with the company recently projecting same-store revenue growth of 2% to 3% and same-store NOI growth of 1% to 2.6% for 2024. Despite this tempered outlook, Brown remains optimistic about Equity Residential's long-term prospects. He emphasizes the intrinsic value of the company's high-quality property portfolio, particularly its focus on multifamily buildings in sought-after urban and coastal markets such as Los Angeles and San Diego. Brown asserts that these strategic investments will continue to deliver value for investors over time. Morningstar shares this positive sentiment, endorsing Equity Residential with a buy rating and assigning a fair value estimate of $87 per share for EQR stock. Despite closing at $60.17 on February 2, Morningstar's assessment suggests that Equity Residential stock may be undervalued relative to its true worth, signaling potential upside for investors considering investment in the company. Number 7. Boston Properties Incorporation. Boston Properties operates as a prominent office REIT, with a portfolio of office buildings situated in key metropolitan areas such as Boston, New York City, Los Angeles, San Francisco, and Washington, D.C. Notably, Boston Properties offers investors an attractive dividend yield of 6%, the highest among the stocks listed. Equity analyst Suryansh Sharma acknowledges Boston Properties' initial 2024 guidance, which forecasts a 2.5% decline in funds from operation for the year, aligning closely with his expectations. Sharma commends Boston Properties' strategic approach, which focuses on owning and developing premier properties known for maintaining high occupancy rates and premium rental rates, even amidst economic downturns. This resilience underscores the company's ability to weather market fluctuations and deliver consistent returns to investors. Morningstar affirms Boston Properties' promising outlook, issuing a buy rating and assigning a fair value estimate of $95 per share for BXP stock. Despite closing at $63.69 on February 2, Morningstar's analysis suggests that Boston Properties stock may be undervalued relative to its intrinsic worth, indicating potential upside for investors considering investment in the company. Number 8. Invitation Homes Incorporation. Invitation Homes operates as a leading REIT, specializing in the ownership, operation, and leasing of single-family homes across the United States, primarily targeting the starter and move-up categories. Analyst Brown anticipates a 3% growth in single-family housing starts for 2024, accompanied by a significant 24% decline in multifamily housing starts this year. Brown emphasizes that the cost of renting in Invitation Homes' core markets is often lower than the cost of home ownership, a dynamic that supports high occupancy rates and facilitates steady rent growth for the company. Moreover, Brown highlights Invitation Homes' ability to enhance operational efficiency and margins by employing its own maintenance and repair technicians, thereby controlling costs effectively. Invitation Homes is seen favorably by Morningstar, which rates the company as a buy and estimates that the stock is worth $41 a share. Despite closing at $33.02 on February 2, Morningstar's analysis suggests that Invitation Homes stock may be undervalued relative to its intrinsic worth, implying potential upside for investors considering investment in the company. And lastly on our list is Ventas Incorporation. Operates as a prominent healthcare REIT, specializing in a wide range of healthcare facilities including specialty care facilities, senior housing, medical office buildings, and hospitals. Analyst Brown highlights Ventas's recent performance, noting an impressive 1.3% sequential same-store occupancy gain in its senior housing portfolio during the most recent quarter. Additionally, the company achieved a total company same-store NOI growth of 7.9%, surpassing expectations. Brown expresses optimism regarding Ventas's future prospects, anticipating that demand growth will outpace supply growth in the coming quarters. He projects that Ventas is on a trajectory to return to its 2019 occupancy levels by 2025, underscoring the company's resilience and ability to navigate challenges effectively. Morningstar reiterates this optimistic prospects, giving VTR stock a buy rating and a fair value estimate of $72 per share. Despite closing at $46.36 on February 2, Morningstar's analysis suggests that Ventas stock may be undervalued relative to its intrinsic worth, indicating potential upside for investors considering investment in the company. These 9 REITs offer compelling investment opportunities in 2024 across various real estate sectors, from healthcare and telecommunications to retail and multifamily residential properties. Despite recent challenges faced by some, each REIT demonstrates resilience and potential for growth, supported by favorable ratings from analysts and Morningstar's assessments. Investors seeking diversification and attractive dividends may find these REITs worthy additions to their portfolios. However, prudent due diligence and consideration of individual investment goals are essential. As always, investors should consult with financial advisors before making any investment decisions. Remember to subscribe to our channel and like this video to receive weekly updates on the finest stocks to purchase as well as innovative wealth-building investment techniques. Thank you for watching, and we hope the upcoming years bring prosperity to your investments.